Joining us today on the show is Maximilan Kunkel, Chief Investment Officer at UBS Global Wealth Management. Hi, Max. Thanks a lot for joining us today. My first question is, what are the key trends that you're witnessing in global equities? Because if I look at last year, it was all about liquidity, and 2018 so far has been about higher volatility in the global markets.
Well, it certainly has already been more volatile. What we are actually seeing is a very different environment to last year. Last year, we had a situation where you had above trend growth, both on a macroeconomic and on a microeconomic side. But that was coupled largely with very strong momentum as central banks were still held back by inflation, which wasn't really normalizing, but that was largely due to technical factors. What we're seeing this year is we still have above trend growth globally, but at the same time, as inflation rates around the world are normalizing, we're also starting to see that a monetary normalization in policy is becoming more imminent. And with that, we have above trend growth coupled with more normal levels of volatility.
Let's talk about the emerging markets basket then, Max. Which are the countries in that basket which are looking attractive at current valuations?
So when we're looking at emerging markets, broadly speaking, we still think that in a world of global expansion on a growth side of things, but at the same time still relatively benign liquidity conditions, emerging markets are likely going to continue to do relatively well. As you already indicated, it becomes more and more important to be also selective here. Our key market, particularly in Asia, continues to be the Chinese equity market.
What's the view in India then, Max? Tell us what kind of exposure do you guys have in Indian equities?
So in India, clearly among equities, continues to be one of those things that you want to allocate to in the long run. More on the tactical side of things, we're neutral on Indian equities at the moment, which is largely due to valuations being a little bit on the high side. We're more than one standard deviation above the long-term average for Indian equities. And although you have an acceleration of earnings growth at the moment, we're forecasting close to 11% this year, 15% next year, we still think that some uncertainty around the elections next year is going to bring the valuation level down, which means that Indian equities are likely going to not perform as well as some other markets in Asia.
So the view, Max, that you're suggesting on India remains neutral, and in the emerging markets basket, as you mentioned, China is something which is looking attractive to you at current valuations. What I want to understand is, have you trimmed your exposure to India if I were to compare it to last year?
So yeah, at the beginning of last year, for example, we went into the year being overweight Indian equities, quite simply because at the time it was a different situation, particularly with regards to the valuation story. What we saw was a very strong rally at the beginning of the year, and then during the middle of last year, we neutralized that overweight position. Just want to be clear, we neutralized it, so we never went underweight here, because we just still think that Indian equities are likely going to deliver positive total returns, but are going to lag behind other Asian markets.
Let's talk about the broader perspective then. Do you see any sort of outperformance in 2018 from developed markets like US, in light of also the scenario where the guidance has been given, there could be more rate hikes, there could be actually 4 hikes instead of the guidance which was given of 3 rate hikes? And also, if one were to go by the recent data, Max, of the non-farm payroll data, which was slightly below what the street was estimating for the month of April, but look at the unemployment data, that's coming at almost 18-year low.
Absolutely. I think when we're talking about the employment data that came out last week, clearly that's one of the most important sets of data that we're looking at the moment, quite simply because historically we know that once the unemployment rate drops 50 to 100 basis points below full employment, markets, particularly in the US, start to get more wobbly. You see labor starting to get more pricing power, and the Fed starting to become more restrictive with regards to its monetary policy, given its dual mandate is close to being achieved. The problem that we have at the moment is that nobody knows where full employment in the United States is. We think that full employment, due to changes in the composition of the labor market, as well as also technological advances, is likely lower than what the Fed estimates it to be at 4.6%. So for us, however, the key element is not to look at the unemployment rate, but rather look at what's happening on the wages side. And here, average hourly earnings is clearly a good indication of that. Looking at last week, actually that was a very, very good result that we got for equity investors. 2.6% growth indicates on the one hand that there's still room for acceleration in consumption, but at the same time, what we're not yet seeing is inflationary pressure being too high for the Fed to become much more restrictive. So you're looking at that, to go back to your question on equity markets, that actually still bodes well for equity markets for the rest of the year.
So in light of all that data, tell us, how do you see the fund flows panning out between the developed as well as the emerging markets?
What we're clearly seeing at the moment, particularly among our client base, is a greater and greater focus on diversification. What we had over the last 2 years was clients focusing largely on their home countries or regions and diversifying part of that away by allocating to US assets. What we're starting to see, particularly I would say over the last few quarters, is a greater and greater move towards global diversification. So that means from a European perspective, taking some chips off the table in the United States, not going completely out of the US though, and moving that towards Asia. From an Asian perspective, it means exactly the other way around, taking some chips away from the United States and moving those assets to Europe. So depending on who you talk to, I guess the trend that we're broadly speaking is trying to reallocate in order to have a more global allocation at the moment, which is important because we are in a situation where around the globe price and asset valuations are generally at elevated levels, and therefore you want to minimize local risks and take advantage of global opportunities.
My last question to you, since you also highlighted China remains attractive in the EM basket, do you think any sort of trade war between China and US is probable this year? If in case that happens, Max, what sort of impact do you see on global markets?
So we would put a 20 to 30% probability on an outright trade war over the next 12 months. So to the second part of the question, which is how would that impact the global environment, would definitely be negative. What we are seeing is that protectionism in a severe way, or trade wars as they're often referred to, lead to higher prices and at the same time mean lower growth. So clearly that would be a negative part. And we are actually also preparing our portfolios for that probability. So what we've done in our portfolios is, despite being still constructive on risk assets, put some counter-cyclical positions in there, such as, for example, being long the Japanese yen against a very open economy, the New Zealand dollar, or, for example, being actually long 10-year treasuries, which should also benefit in such a scenario.
Appreciate you, Max, joining us today and taking us through your views on global equities.